Always, there is, more and more tokens being added, and specifically with the St. Regis today being a real estate security token, I figured we could take today's main topic to talk about the different types of real estate tokens one might start seeing in the near future.
Real estate has historically been a strong asset class, and home ownership was one of the best ways to build wealth for many families throughout history. But real estate is enormous, and there are lots of different ways to get exposed to it.
Yeah, it really is actually incredible how many different ways real estate can be profitable. That's why I think it helps to really create a framework when it comes to evaluating real estate opportunities. So, this framework I use consists of two layers. The first layer I call the instrument layer.
Let's make some music, man. What kind of instruments we playing?
Well, I feel like we're making beautiful music with this show, dude. But no, to be real, I'm talking about financial instruments, of course. And think of it like what I'm buying into, right? So when it comes to real estate, I really see four different types of instruments to play with, if you like. So the first two are easy: debt and equity, right? Plain and simple, these two. Let's say we're going to build let's build a skyscraper here in the financial district of Miami, which is, it's called Brickell, by the way. And to do so, we'll probably need, let's call it $200 million. So the way it works today is Kyle and I will go to all the real estate broker firms and banks directly, because real estate is an antiquated industry that will be massively disrupted by tokenization, by the way. But anyway, Kyle and I shop around our deal, as the lingo would go, and we'd raise $100 million in debt, let's say, call it the construction loan, and another $100 million in equity, which is, of course, the ownership of the building. Which, by the way, of course, helps pay off that $100 million construction loan as we build our skyscraper. Now enter tokenization, which means the loan and equity can be financed via the crowd from around the world instead, creating a fairer and larger marketplace for real estate developers like Kyle and I.
That's a great example, Herwig. The debt and equity, of course, are different instruments because they have their own investment profiles. Debt is less risky and typically focused around a stable yield and a predetermined maturity rate, provided that we don't have construction delays. Equity, on the other hand, won't be harvested for a long time and is only really profitable when condo units are sold or when we have tenants paying rent. The land and building does appreciate in value, so there's also that appreciation, but to benefit from that, the debt doesn't have. But as we've seen in the legacy secondary markets, the lack of robust and developed trading markets results in a reality that the equity appreciation usually isn't realized for investors until a full sale of the building has occurred many years after the building is completed, something that tokenization can absolutely revolutionize.
That's exactly right. Real estate really, it's going to get flipped on its head, I think, over the next 5 years as tokenization takes center stage. But getting back to it, now that we've gotten through two simple instruments here, let's get a little advanced. The third type is a fund vehicle. Now, fund vehicles can come in all forms of shapes and sizes, and yet again, as you said, Kyle, have a different return profile as a result. Here you are becoming what is called a limited partner, which is the backer, the investor into the fund itself, so that a manager can go out and deploy that capital on your behalf. And this means, depending on the goals of the fund, aka the real estate asset types it goes after, maybe the geography, the instrument types it goes after, the risk tolerance and the return targets, all of that is, they're different parameters for each fund that you might need to consider.
I'm also going to jump in there and add that with this instrument, you're typically relying on historical return data to see the annual yield or growth of the fund by the managers to determine if it meets your investment profile, with the idea here being that you can get exposed passively through an actively managed portfolio of real estate deals that the fund is going after. It's a nice way to expose yourself to real estate without actually having to become the expert in the specific asset behind the debt or equity offering.
Well put, Kyle. Well put. So between those three instrument types, you can cover and expose yourself to really a lot of different types of real estate, pretty much all of it, which now let's get to that second layer, which is, of course, the asset layer. But before I jump to that, I will mention that, of course, that fourth type of instrument, which purely could be really anything that eventually will emerge as a result of tokenization, right? We were just talking about profit rights and things like that. That's not common in real estate, but perhaps we're going to start seeing that. A derivative potentially of another real estate asset, a blockchain lending protocol, all of these things that may not even have been imagined yet will come about because of security tokens. And so there, don't keep in mind that there could be a fourth instrument type when you're kind of evaluating things if they don't fit into that equity, debt, or fund profile.
Yeah, you'd have to assume that more instruments are going to be created in the future thanks to the flexibility that's offered by tokenization. But these three are the three main vehicles in a real estate asset or assets you're going to invest in from the legacy financial perspective.
Right, right. So keeping things within the framework, we've got our layer one lens. When we see a real estate token, we need to figure out, is it a debt offering, an equity offering, a fund offering, or is it something else entirely? Once we've identified that, you can better evaluate the asset or the assets itself. And this is where real estate really becomes vast. You can identify single asset opportunities or start investing in multiple assets or portfolios of real estate as well, right?
I think it really helps to look at the asset layer from a life cycle and sector perspective. So when you're comparing on a sector to sector level, it's actually pretty straightforward. We're talking about geography, the type of real estate, for example, whether it's commercial, residential, and each of those have specific categories as well. We've got office buildings, strip malls, hotels, and resorts, or on the residential side, there are the single or multi-family homes, condos, timeshares, and the list goes on. Each one of these asset types has different risks and return profiles that need to be compared with the context of which vehicle you're investing in.
Okay, so I definitely think we can all wrap our heads around this, right? So we find a token, we see if it's typically either a debt, equity, or fund offering, and then we identify what is it for, the location and actually underlying real estate type or types in a multiple asset situation. So far so good, I think, but you mentioned this life cycle. What do you mean by that?
Right. So far so good, but this last component to consider is the lifestyle component. So going back to our skyscraper example, real estate investors participate in returns in various stages of the life cycle of the business. For example, the construction loan might become refinanced, and we may take out several more loans against the building along the way. Equity-wise, we as developers may sell the skyscraper to a big office firm or Fortune 500 or hotel chain, which, by the way, typically doesn't happen directly. Those are usually funds or brokers that are involved in the middle that come in to assist with that process.
Okay, so what you're saying is based on the life cycle of the asset, the risks and returns differ. So distributions may differ, equity appreciation, of course, differs at different stages. Obviously, a finished building with tenants is far less risky than a plot of land with nothing on it yet. So all of this needs to be accounted for, definitely. A great way to look at it, Kyle.
Absolutely. It would be no different than looking at a business and figuring out where in the life cycle that business is. But I also think that it may help our audience if we use a couple examples. So the St. Regis, which is a timely one because it just went live on T0, we can now look at first. So for example, the instrument type is equity and the asset type is commercial real estate, specifically a hotel in the region of Colorado, and it is completed structure. So immediately I can conclude that I would want to see the historical revenue and the previous sale history of the asset itself to get a good idea for the possible return profile. And then I might do some research on Colorado and Aspen land price appreciation to maybe scope out the competition as well in the area before I invest to make sure I'm comfortable with what I'm buying real estate wise. You need to consider the instrument as well as the underlying property and where it fits in.
Definitely a great example there. I think another one for realty tokens, right, which there are almost 20 of them listed now. You'll find that it's the same deal. It's also equity. In this case, you get exposed to individual homes in Detroit, specifically, though, Section 8 housing, which means the rent is partially guaranteed by the government, right? A nice risk detractor worth considering. Maybe this hurts the possible return profile, though, but if you're still happy with it, which for them, I still think it's sometimes double-digit returns according to their historical data. So also a similar profile to Kyle's example, but the difference here is we have a government-subsidized entity, and then the fact is that we're also dealing with residential in Detroit, not commercial in Aspen. Also very different stories.
And that's why I think that real estate is so exciting. Opening up investment access to geography, real estate type, portfolios, debt, all this hasn't been possible before, and all of it can be tokenized and owned on a fractional level for drastically reduced minimum investment requirements.
And it really is expensive. I mean, you can invest in lenders for mortgages. That's a debt instrument example, right? Or invest in an existing portfolio of assets via a fund. And funds can go buy more tokenized real estate. So now you're building on top of each other. So very soon it will be much easier for investors all around the world to develop a portfolio of real estate. They never have to go and visit the portfolio themselves physically. It can be exposed to dozens of sectors, regions, and instrument types, leading to, of course, a healthy real estate investment portfolio that is diverse. So honestly, if loving that is wrong, I don't want to be right, Kyle.
Absolutely, Herwig. I also recommend talking to friends or colleagues in real estate if you know any. By telling them your return profile goals and your risk tolerance, they may be able to steer you towards a sector or instrument based on that. The real estate world is truly going to be transcended by security tokens in a whole new asset class, and I personally can't wait. And it's happening as we speak, folks. So hopefully this episode was helpful for you as you learned in detail the real estate process and helps you better understand how to evaluate potential token opportunities in real estate. As always, we're happy to answer any questions on this as well. If you want to reach out via Twitter or LinkedIn, you can find us there.
Absolutely. And also please join the rest of the community on stomarket.com/news. That's where we submit everything we find. We discuss the news and other security token topics. You can also find all of our main topic segments of the Security Token Show on YouTube. And we also have tons of great media and content for you over at the Security Token Group Medium blog. So with that, I want to thank you, wonderful listeners, for joining us on another episode, and I hope to catch you next week.